Have you ever wondered how the richest investor in the world makes his money?
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Warren Buffett isn't just rich because he picks stocks. He has a simple, almost shocking approach that anyone can follow. Today, I'm going to reveal why Warren Buffett only recommends two specific index funds for most people, and how you can use this secret to grow your wealth without stress or guesswork. Stick with me till the end, because what you learn here could change the way you invest for the rest of your life. Let's start with the big question. Why only two index funds? Most people think investing is complicated. They think you need to spend hours analyzing charts, reading company reports, or following the stock market news. But Buffett knows a truth that most people overlook. Most investors do worse than the market because they try to beat it, and the market rarely loses. So, what is an index fund? It's basically a collection of many stocks that track a particular market index. Think of it like a basket filled with hundreds of the biggest companies in America. Instead of buying one stock and hoping it goes up, you're buying a tiny piece of every company in that index. That means your investment grows as the overall market grows. It's simple, smart, and powerful. Now here's the kicker. Buffett doesn't just recommend any index funds. He has a very specific choice. One of them tracks the S&P 500, which is a group of the 500 largest companies in the U.S. The S&P 500 includes giants like Apple, Microsoft, and Amazon. The other fund he recommends is a total market fund, which includes almost every publicly traded company in the country. That's right. He's basically telling people to own a piece of the entire U.S. economy. You might be thinking, why not pick the next Tesla or the next Amazon? Why not invest in individual companies and try to make a fortune quickly? Here's the answer. Predicting which companies will succeed is really, really hard. Even Buffett himself admits that picking individual stocks is risky and time-consuming for most people. In fact, he says that a simple index fund is the best way for a non-professional investor to grow wealth over time. And it's not just words. Buffett puts his money where his mouth is. In his will, he instructs that 90% of his wife's inheritance should be invested in a low-cost S&P 500 index fund. That's a level of confidence that few investors have. Let me ask you something. Have you ever invested in a stock because everyone was talking about it, only to watch it drop the next month? How did that make you feel? Drop your answer in the comments section. I want to see your experiences. Back to Buffett. What makes these two index funds so special? First, they are low cost. Most actively managed funds charge high fees, often 1% or more per year. That may sound small, but over decades, fees can eat away a huge portion of your wealth. Index funds, especially the ones Buffett recommends, charge tiny fees, sometimes as low as 0.03%. That means more of your money stays invested, compounding over time. Second, these funds are diversified. Diversification is investing in many companies at once, so if one company fails, it doesn't destroy your entire portfolio. The S&P 500 includes a wide range of industries, and the total market fund covers even more. This spreads your risk in a way that most single-stock investors never achieve. Third, they are passive investments. You don't have to watch the stock market every day, or worry about short-term ups and downs. In fact, Buffett himself says that the stock market is like a voting machine in the short term and a weighing machine in the long term. That means the market may swing wildly day to day, but over years and decades, it reflects the real growth of the economy. By investing in an index fund, you benefit from long-term growth without stress. Here's something that's often overlooked. Timing the market is almost impossible. People try to buy low and sell high, but research shows that even professional investors fail to consistently do this. Buffett knows this, and that's why he advocates a hands-off approach with index funds. You just invest regularly, ignore the noise, and let compound interest work its magic. Have you ever tried timing the market? Did it work out for you? I'd love to hear your story in the comments. Now, I want to address a common fear. What if the market crashes? It's true, the market goes down sometimes, but history shows us that over the long term, the U.S. stock market has always recovered and grown. The S&P 500 has delivered an average annual return of around 10% over the last 90 years. That's not a guarantee, of course, but it shows the power of long-term investing. And the beauty of index funds is that you don't have to worry about picking the right time. Just stay invested, even through crashes. Another reason Buffett loves these two funds is simplicity. Life is complicated enough. Your investments shouldn't be. By sticking to one or two index funds, you remove the stress of constantly making decisions about which stock to buy, which company to avoid, or when to sell. Simplicity leads to consistency, and consistency leads to wealth. I have a question for you. If you could invest in the entire U.S. economy and watch it grow over decades, would you do it? Or would you prefer to try picking individual stocks? Drop your answer in the comment section. I'm really curious what you think. Let's talk about compounding, because this is where the magic happens. If you invest $100 a month in an index fund, over 40 years with an average 10% return, you'll end up with more than $1 million. That's the power of time and compound interest. And the best part? You didn't need to pick a single stock or predict the market. You just stayed consistent. Buffett also emphasizes the importance of low fees. Have you ever checked how much your mutual fund charges? Those 1 to 2% fees that some funds take each year can destroy your long-term returns. Index funds are cheap, which means more of your money stays invested. And over decades, that difference is huge. Here's a thought-provoking idea. Why do most people chase individual stocks, thinking they'll get rich quickly, when the data shows that most would be better off investing in a low-cost index fund? It's because human nature loves excitement and quick wins. But Buffett is proof that slow, steady, and disciplined investing wins in the long run. At this point, I want to ask you to do something. If you're enjoying this video and learning something new, hit that like button, subscribe, and share this video with friends who want to invest smarter. Trust me, they'll thank you for it. Now let's consider risk. Many people think index funds are boring because they won't make you a millionaire overnight. But boring is beautiful when it consistently grows your money year after year. Buffett has often said, the stock market is designed to transfer money from the active to the patient. In other words, those who chase excitement lose, while those who stay patient and invest consistently win. Here's something amazing. Studies show that over 30 years, the S&P 500 has beaten over 90% of professional fund managers. That's right. Even the experts often fail to beat the market. So by investing in the S&P 500, you are actually making one of the smartest moves possible. Let's talk emotions. One of the hardest things about investing is controlling your feelings. Fear and greed make people sell low and buy high, which is exactly the opposite of what works. Index funds remove much of the emotion because you don't need to make daily decisions. You just invest regularly and stay the course. Have you ever sold a stock in panic because the market dropped? Or bought something because everyone else was buying? Share your experience in the comments. I want to see how emotions have affected your investing. Buffett also teaches us the value of long-term thinking. If you invest in index funds and never touch them for decades, you benefit from compounding, dividends, and market growth. It's not glamorous, but it works better than chasing the next hot stock tip. Another reason Buffett recommends only two funds is tax efficiency. Index funds generally generate fewer taxable events because they trade less frequently than actively managed funds. That means you keep more of your money instead of paying high taxes every year. Here's a question to think about. If someone offered you a simple, proven way to invest for the future with minimal effort, would you take it? Or would you risk trying to beat the market on your own? Drop your answer in the comments. I'd love to see what you think. So, to summarize why Buffett only recommends two index funds. Simplicity. One or two funds is easy to manage. Diversification. You own a piece of hundreds or thousands of companies. Low fees. More of your money stays invested. Passive investing. No need to time the market. Long-term growth. Historically, these funds have consistently increased in value. Tax efficiency. Fewer taxable events means more compounding. Here's the final thought. You don't need to be a genius to invest like Warren Buffett. You just need patience, consistency, and the right approach. By investing in a low-cost S&P 500 index fund and a total market fund, you can take advantage of the same strategies that have made Buffett one of the wealthiest people on the planet, without the stress, the guesswork, or the risk of picking the wrong stock. So now I want to hear from you. Are you ready to take a simple, proven approach to investing, or do you still feel drawn to picking individual stocks? Share your answer in the comments. Let's get a conversation going. Remember, if you liked this video, like, subscribe, and share it with your friends. There's so much more investing wisdom coming your way, and I promise it will be easy to understand and apply. Don't miss out on turning your money into something powerful over time. Warren Buffett's strategy is simple for a reason. It works. And the best part is, you don't need to be rich, famous, or a financial expert to start. All you need is consistency, patience, and the right funds. The question now is, what's stopping you from starting today? Is it fear, doubt, or maybe confusion? Whatever it is, drop your thoughts in the comment section. I read every single reply, and I want to help you think this through. Investing doesn't have to be complicated. It doesn't have to be scary. And you definitely don't need to spend hours studying individual stocks. Warren Buffett's 2-index fund strategy is proof that simplicity beats complexity every single time. So take a deep breath, consider your options, and make a plan. Because the earlier you start, the more time your money has to grow, and the closer you get to financial freedom. At the end of the day, the smartest investors aren't the ones chasing the next big stock. They are the ones who understand the power of patience, compounding, and simplicity. Warren Buffett's 2-index fund approach is your blueprint to doing exactly that. So, tell me, are you ready to follow Buffett's advice and make the long-term, patient choice? Or will you try to beat the market on your own? Drop your thoughts in the comments. I can't wait to read them.